You land on a palm-lined island. The breeze is perfect. The coffee is somehow better. And your friend whispers, "Dude, go offshore and you'll pay no taxes. Ever." That's the dream people sell in comment sections and poolside chats. The reality is smarter, stricter, and, if you play it right, still very good. Let's start with the word itself. Offshore is a direction, not a magic spell. It simply means you're using a company, account, or structure in a country that is not the same as where you live or where your customers live. Some of these places have low or zero corporate tax. Some only tax income earned inside their borders and ignore the rest. Some are normal tax countries with special regimes like research incentives or holding company rules. And some are just efficient, stable hubs where business gets done fast. None of that makes you invisible. It just changes which rules apply. Think of it like choosing a different stadium to play in. The field is still grass, the referees still wear whistles, and the score still counts. Here's the first simple idea that quietly runs the entire movie. Every tax system asks two questions. Are you one of ours? That's residency, where you or your company are considered to live for tax purposes. And where did the money come from? That's source, where the economic activity actually happened. Residency decides whether a country wants a cut of your worldwide income. Source decides if they want a slice of a particular deal. When people say, go offshore, they usually try to change residency for a company while hoping source doesn't pull the money back to where the work really happened. If you can hold both in your hands, residency and source, you can predict almost every tax answer like you're reading the teacher's guide. So why do low-tax jurisdictions exist at all? Because countries compete for different things. Some compete for factories and need to be near raw materials. Some compete for finance and logistics and need to be stable, connected, and predictable. A handful compete by saying, bring your holding company, your ships, your planes, your investment funds, your regional headquarters. We'll charge little on profits that aren't made here. We'll keep rules simple, and we'll give you courts, treaties, and airports that work. That's not cheating. That's policy. But policy comes with strings. You don't get a prize for showing up. You get a prize for actually doing real business, the way the rules describe. And those rules changed a lot in the last decade. There was a long party where letterbox companies with no staff picked up profits that smelled like they were earned elsewhere. That party ended. The global project, with a very long name, pushed countries to ask for substance, which is a grown-up way to say, if you say the company lives here, show me the life. That means board meetings in the place, local directors who make decisions, an office you can find on Google Maps, people who do the work you claim is done there, and records that match the story. If your offshore company is just a mailbox that forwards mail to another mailbox, today's rules will treat it like a ghost and follow the profits back to the people and places that did the work. Let's define the main building blocks. A holding company is a box that owns other boxes. It receives dividends and can sell shares. In some hubs, dividends received from subsidiaries can be exempt or lightly taxed, and selling shares can be tax efficient if you meet conditions. A trading or operating company is the box that actually does things, sells, ships, codes, invoices. A finance company is a box that lends money. An intellectual property company holds your patents or brand and charges royalties to operating boxes. A fund or special purpose vehicle holds investments separate from the rest of your life, so investors don't panic. Each box has rules. The trick is to put the right work in the right box, in the right place, and then actually live by your own diagram. Your home country does not stop caring about you just because your company is sunny. Most high-tax countries have controlled foreign company rules, or CFC rules. These look at companies you control in low-tax places and say, if that company mostly earns passive income or runs on autopilot with no real people, we will tax you on those profits at home as if you received them. That means the profits don't get to nap forever offshore just because the local rate is low. To make CFC rules yawn and go back to sleep, you need real activity in the offshore place. And you need the type of income to be active: sales, services, logistics. Not just a box that collects interest and royalties while you work from a different country. Even if your offshore company is real and active, the country where your customers or your team are may still want a piece through source-based rules. If you keep a fixed place of business in a country, a shop, an office, a workshop, or you have someone there who habitually signs contracts on your behalf, you can create a permanent establishment, a local taxable presence. Some treaties even say that if you come in and do services long enough, without an office, that can still count. So if your offshore company is in one place, but your sales team, warehouse, or boss with the signing pen actually sits in another, Don't be shocked when the other place knocks and asks for tax on its slice.
Let's make this real with a friendly story. You're a designer in one country, your main market lives in another, and you open a company in a third that promises low corporate taxes and fast setup. If you keep doing the work from your first country with your laptop at your kitchen table, that first country can still tax the income because the services were performed there. The offshore company might be fine as a billing tool, but Source brings the profits home. If you move yourself to the offshore place, hire there, decide there, and actually deliver services from there, now Residency and Source line up, and the plan makes sense. Same diagram, different facts, different outcome.
Banking is where myth meets adult supervision. People imagine secret accounts and steel vaults with no names. Real banks want your entire life on a PDF. That's not an insult. That's how modern finance works. Expect to show passports, proof of address, tax numbers, corporate documents, business plans, contracts, invoices, and sometimes screenshots of your app or store. Expect them to ask who your customers are, what countries they're in, how you get paid, who owns you, and whether any of you are politically exposed or on a watch list. If your story is, we provide services globally, and your invoices say, consulting, prepare to be specific. Banks dislike fog. They don't need you to be big. They need you to be clear. Let's talk treaties, because that word gets thrown around like confetti. A tax treaty is a deal between two countries about who gets to tax what and how to avoid double taxation. Treaties can reduce withholding on cross-border payments like dividends, interest, and royalties, and they include rules about permanent establishments and tiebreakers for residency. But treaties are not potions. To use a treaty, a company normally needs to be a resident of the treaty country, and many countries ask for beneficial ownership tests and principal purpose tests. If the only reason your company exists in that country is to collect a treaty discount, you may fail the purpose test. If your company is run from somewhere else by someone else, you may fail the residency test. The adult version of treaty shopping is substance-backed structuring. You put the people and decisions where the treaty lives, then you take the benefit you actually qualify for. By this point, you might be thinking, okay, so zero tax is fake, banks ask for my diary, and treaties want proof. Why does anyone do this? Because good offshore done right solves real problems. It can legally reduce taxation on dividends moving up a corporate chain. It can simplify exits by holding a business under a clean, investable top company in a neutral place. It can ring-fence risks, protect intellectual property with clear courts, and put you in a time zone and legal system that your partners trust. And yes, if you align substance with a territorial system that only taxes local profits, you can legitimately earn foreign profits with low or no additional tax in the hub. The key word, tattoo it on your palm, is legitimately. Here comes the section where we break the biggest myths with a wooden spoon. Myth 1. No tax if the company is in a zero-tax country. Reality. Your home country's CFC rules and management and control tests can still pull the profits back. Myth 2. Under a magic day count and I'm safe. Reality. Day counts are one ingredient. Permanent home, center of interests, and where work is actually done can beat the calendar. Myth 3. Marketplaces and app stores take care of the taxes. Reality. They may handle sales tax or VAT at checkout for specific transactions, but they don't file your corporate returns, and they don't fight your CFC battle. Myth 4. Nominee directors mean no questions. Reality. If the nominee rubber stamps what you decide elsewhere, you've written an email trail that proves the opposite of what you need. Myth 5. Crypto means no bank. Reality. When you eventually touch fiat, or when a platform reports your income, the paper trail reappears, waving. Let's give you a clean model to think with. No buzzwords, no magic. First, you decide your goal. Are you trying to build a regional hub to serve customers in a part of the world? Are you creating a clean holding company for investors and future exit? Are you moving yourself and your family to a place with simpler taxes for a season of life? Each goal suggests different places and different boxes. Second, you map the facts. Where are you? Where are your team? Where are your customers? And what do you sell? If the work is done in country A and customers sit in country B, don't pretend a box in country C can swallow the entire profit without either A or B saying hello. Third, you check your home rules. If you stay resident in a high-tax home, learn your CFC rules, your reporting obligations, and the consequences of management and control being at your kitchen table. Fourth, you perform a bank test. If a bank in your shiny jurisdiction doesn't want your business model,
pick a different plan before you print stationery. Fifth, you meet the substance bar. Real directors, real meetings, real minutes, an office that isn't a shelf. Staff or key vendors on the ground, contracts signed where you say decisions happen. Sixth, you draft transfer pricing logic like a human, not a robot. If you scatter functions across countries, dev here, marketing there, headquarters elsewhere, write a story that explains who earns what and why. It's called a policy, but in court it reads like a novel. Make it believable. What about those economic substance laws you keep hearing about? In many low-tax jurisdictions, companies in relevant activities, like distribution, headquarters, financing, IP holding, must show core income-generating activities in the place. That means people, budgets, and decisions that match the income. If your company claims to run a financing business, but has no one deciding on loans in that country, you fail. If your IP company claims to develop and exploit patents, but all engineers are elsewhere, you fail. The fix isn't complicated, it's just adult. Put the activity where the company lives, or put the company where the activity already lives. Paper follows people, or people follow paper. There isn't a third door anymore. Let's wade into VAT and digital taxes, because they sneak up on offshore dreams like a tide. Corporate income tax is the headline, but consumption taxes are the drumbeat. If you sell digital services to consumers in the European Union or the United Kingdom, you may owe VAT at the customer's rate, no matter where your company sits. There are simplified portals that let you register once and report to many countries. Marketplaces often collect VAT for sales made through them, but your direct store is your responsibility. Then there are digital services taxes in certain countries, a gross revenue charge on ad platforms, marketplaces, and similar services. If your customers sit in those places, your invoices can show platform fees that include these charges. None of this is defeated by a beach. The only way to handle VAT and digital taxes is to add them to your operating system. Price correctly, register where needed, report on time, and treat the money as belonging to the government from the moment you collect it. You might ask, okay, but how do the big players do it without crying? They plan early, match people to profits, and stay inside the lines. The common pattern is a holding company in a treaty-rich, stable place that owns operating companies where teams actually work. Dividends flow up under participation exemptions. Management and IP live where the brains are and where courts are predictable. Financing happens in regulated, respected hubs with real teams. The effective tax rate is the result of activity choices, not a rabbit pulled from a hat. The difference between that and a weekend scheme is the distance between a surgeon and a YouTube tutorial. Time for a mini drama. You're a creator with subscribers everywhere and payouts from platforms in multiple currencies. Someone tells you to open a zero-tax company, route all money there, and never look back. You do it. You keep living where you've always lived. You post behind-the-scenes videos in the same apartment with the same view. You pay your editor and your assistant in your home city. Your offshore company suddenly looks like a coat you put on your old life. Your home country says, charming, those are our profits. The bank notices that all decisions are taken from your home IP address and asks why. A platform starts reporting to your home tax office. The letter arrives. Or, version 2, you actually move. You register locally. You rent a studio. Your decision makers and contracts live in the same place as your company. You still file what your home country requires for the year you left. And maybe you still report because you remain a resident there for part of the year. But next year, your story is whole. Same corporate shell, one version fails, one version works. The difference is not the logo, it's the life. We should also talk about reputational gravity. Some low-tax places are perfectly legal, but spook partners, payment processors, and investors. If your plan includes venture capital, enterprise clients, or going public, pick jurisdictions those audiences already understand. They're not always the cheapest on paper, but they are the cheapest in stress. A great jurisdiction for a family holding company isn't always a great jurisdiction for a software startup or a marketplace. Choose with your endgame in mind. What about secrecy? Automatic information exchange means banks and financial institutions now report account data to home tax authorities under global frameworks. If you thought an account in one place could hide forever from another, that movie ended years ago. Even if a small institution forgets to send a postcard, the moment you move money to a bigger bank or a platform that reports, the postcard writes itself. Privacy still exists in the sense that the whole internet doesn't see your balance. Secrecy, in the sense of no one will ever know, is a fairy tale with a sad ending. You deserve a one-sitting checklist you can memorize. Start by writing your why in one sentence. I want a neutral holding company for investors and future exit. Or, I want to relocate and actually live where my company lives. Or, I want a regional operating hub with low tax on foreign profits. If your sentence is, I want no tax and no paperwork, try a different hobby. Next, sketch your people map. Where do you and your key decision makers sit? Where are your customers? Where are your vendors? That map is your tax picture. If you need to move dots, move them before the structure, not after. Then, pick a jurisdiction that matches your why and passes the bank test. Read its substance rules like a bedtime story. If you can't meet them, pick another place or change your plan. Draft a board calendar and stick to it. Sign contracts where the company lives. Keep minutes that show thought, not rubber stamps. And keep your own home country filings up to date. Disclosure forms, foreign company reports, controlled company inclusions. The fastest way to ruin a good offshore is to hide it from a tax office that will learn about it anyway.